Lehman Brothers filed for Chapter 11 bankruptcy on September 15, 2008, marking the largest bankruptcy in U.S. history. Their equity leverage ratio stood at a staggering 31:1, with holdings in risky real estate 30 times greater than their capital. How did this financial titan fall so quickly, and what were the broader ramifications? Lehman Brothers, a financial institution with 158 years of history, faced its demise during the 2008 financial crisis. The firm was heavily exposed to subprime mortgages, a sector that would soon unravel. Lehman's high leverage ratio and investments in low-rated mortgage-backed securities contributed significantly to its vulnerability. In 2007, Lehman Brothers reported a $50 billion exposure to subprime mortgages. This exposure was accompanied by a drastic decline in stock value, eroding the confidence of its clients. Efforts to stabilize the company included talks of selling its investment management division for $2.5 billion. However, these efforts were insufficient. In August 2008, Lehman planned to lay off 1,500 employees. This was a precursor to the larger crisis that was about to unfold. On September 11, 2008, J.P. Morgan Chase halted Lehman's borrowing, cutting off access to $100 billion in funding. Just days later, Barclays withdrew its bid to purchase Lehman, leaving the firm without a lifeline. As Lehman Brothers filed for bankruptcy, the Dow Jones Industrial Average saw a 4.5% drop in a single day. The bankruptcy sent shockwaves through global markets, leading to a sell-off in the commercial mortgage-backed securities market. The collapse of Lehman Brothers exacerbated the already unfolding global financial crisis. Lehman Brothers' fall illustrated the fragility of financial systems deeply intertwined with high-risk assets. The stakes were immense, affecting thousands of employees and contributing to a general financial panic worldwide. Lehman Brothers' rise to prominence in the financial world was marked by strategic decisions and market positioning. The company was spun off in an initial public offering in 1994. It capitalized on the economic conditions of the late 1990s and early 2000s, making several key acquisitions that expanded its portfolio and influence. In 1997, Lehman Brothers acquired Aurora Loan Services. This move allowed Lehman to delve deeper into the mortgage market, which was experiencing significant growth at the time. The firm continued its expansion by purchasing BNC Mortgage LLC in 2000. These acquisitions positioned Lehman Brothers as a formidable player in the mortgage lending space, a sector that was booming due to the housing market's growth. By 2001, Lehman Brothers further strengthened its capabilities by acquiring Cohen & Co. Private Client Services business. This acquisition provided the firm with a broader client base and increased its foothold in the investment banking sector. The strategic move into asset management in 2003, with the $2 billion investment, underscored Lehman's intent to diversify its operations and revenue streams. Lehman Brothers' aggressive expansion was supported by favorable market conditions. The early 2000s saw a surge in demand for mortgage-backed securities and complex financial products. Lehman leveraged this demand, becoming a leading underwriter of these securities. The firm's ability to innovate and offer high-yield products attracted significant investment and bolstered its reputation. The company's equity leverage ratio of 31:1 reflected its aggressive growth strategy. This high leverage allowed Lehman Brothers to amplify its investments and returns during the market's upward trajectory. However, it also increased the risks associated with market volatility. Lehman's strategy was to capitalize on the booming real estate market, which promised lucrative returns. The firm was also involved in high-profile real estate transactions. In 2001, Lehman acquired a nearly completed office tower from Morgan Stanley for $700 million. This acquisition was part of Lehman's strategy to invest in prime real estate, which was considered a stable and appreciating asset class. Lehman Brothers' rise was characterized by rapid expansion and strategic acquisitions. The firm capitalized on favorable market conditions and positioned itself as a leader in mortgage-backed securities and real estate investments. However, this aggressive growth strategy, coupled with high leverage, would later contribute to its vulnerability. As the firm expanded, it became increasingly exposed to the risks inherent in the financial markets it operated within. The turning point for Lehman Brothers came in the days leading up to September 15, 2008, the firm faced mounting pressure from multiple fronts. On September 11, 2008, J.P. Morgan Chase, a key lender, ceased Lehman's borrowing capabilities, effectively cutting off a vital line of credit. This decision resulted in a liquidity crisis for Lehman Brothers, exacerbating its already precarious financial position. Just a day later, on September 12, a critical meeting was convened to discuss the future of Lehman Brothers. The firm was in urgent need of a buyer to stabilize its operations and restore confidence. However, potential buyers were hesitant. Barclays, a British bank, initially expressed interest in acquiring Lehman. Yet, by September 14, Barclays withdrew its bid due to regulatory hurdles and a lack of support from British authorities. The failure to secure a buyer left Lehman Brothers without options. The firm's exposure to subprime mortgages and high leverage ratio had already eroded client confidence. A rapid decline in stock value further compounded the crisis. Lehman's inability to offload its less liquid assets intensified the situation, leading to a drastic devaluation of its portfolio. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. This event marked the largest bankruptcy filing in U.S. history. The filing triggered a global financial panic, with markets reacting swiftly to the news. The Dow Jones Industrial Average plummeted by 4.5% in a single day, reflecting the widespread fear and uncertainty. The collapse of Lehman Brothers sent shockwaves through the financial system. It was a pivotal moment in the 2008 financial crisis, underscoring the fragility of financial institutions heavily invested in subprime mortgages and complex financial derivatives. The absence of a bailout or acquisition deal for Lehman highlighted the limitations of regulatory frameworks in managing systemic risks. In the aftermath, Lehman's bankruptcy contributed significantly to the sell-off in the commercial mortgage-backed securities market. The firm's downfall exacerbated the global financial crisis, leading to severe economic repercussions worldwide. The events of September 2008 served as a stark reminder of the interconnectedness of global financial systems and the potential consequences of unchecked financial practices. Following the collapse of Lehman Brothers, the financial landscape experienced immediate and profound shifts. The largest bankruptcy in U.S. history led to a 4.5% one-day drop in the Dow Jones Industrial Average. This marked a significant moment of panic in global markets. Lehman's failure was a catalyst for a broader financial crisis. The sell-off in the commercial mortgage-backed securities market intensified. Global markets plummeted, reflecting the deepening mistrust in financial institutions. The collapse underscored vulnerabilities in the financial system, particularly those tied to subprime mortgages and high leverage. The repercussions were not limited to market indices. Over 6,500 employees were displaced, with Lehman's European operations alone employing 5,500 at the time of the collapse. The aftermath saw continued liquidation processes, with Lehman Brothers Holdings still in liquidation as of September 2022. Nomura Holdings acquired Lehman's investment banking and equities businesses in October 2008. This acquisition included Lehman's franchise in the Asia-Pacific region, marking a significant shift in the control of these operations. Barclays also reached an agreement to purchase Lehman's North American investment banking and trading divisions, approved on September 20, 2008. The financial turmoil following Lehman's bankruptcy had lasting effects. It highlighted the systemic risks associated with high leverage ratios and exposure to less liquid assets. The crisis prompted regulatory bodies to reassess financial oversight and risk management practices. The collapse of Lehman Brothers not only intensified the global financial crisis but also served as a cautionary tale. It demonstrated the potential consequences of aggressive financial strategies and the interconnectedness of global markets. The events of 2008 remain a pivotal moment in financial history, shaping policy and practices in the years that followed. The collapse of Lehman Brothers serves as a critical lesson in financial oversight and risk management. The firm's heavy exposure to subprime mortgages and high leverage ratio exemplified the dangers of aggressive financial strategies. Lehman's bankruptcy highlighted the systemic vulnerabilities present in global financial systems. It underscored the need for robust regulatory frameworks capable of managing systemic risks. The absence of a bailout or acquisition for Lehman revealed significant limitations in existing regulatory approaches. It prompted a reassessment of financial oversight practices worldwide. The financial crisis that followed Lehman's collapse led to extensive reforms in risk management and regulatory policies. These reforms aimed to prevent similar systemic failures in the future. Lehman's failure was not just a corporate downfall. It was a catalyst for broader economic change. The panic it triggered in global markets emphasized the interconnectedness of financial institutions. It demonstrated how the collapse of a single entity could have far-reaching consequences. The lessons learned from Lehman's collapse continue to influence financial policy and practice today. The legacy of Lehman Brothers' collapse is a reminder of the importance of financial stability and transparency. It serves as a benchmark for evaluating the effectiveness of current financial regulations and risk management strategies. The events of 2008 remain a pivotal moment in understanding the dynamics of global financial systems. The collapse of Lehman Brothers was a watershed moment in financial history. It revealed the fragility of global financial systems and the dire consequences of unchecked risk-taking. The firm's downfall, driven by its high leverage and subprime mortgage exposure, underscored the need for stringent regulatory oversight. This failure catalyzed significant changes in financial policies and practices worldwide. It serves as a stark reminder of the importance of financial stability and the potential impacts of interconnected global markets. As we reflect on this event, we recognize the critical importance of vigilance in financial oversight. Understanding these lessons remains crucial in safeguarding against future crises.